What if the next financial crisis doesn't begin with a bank collapse or a market crash, but with a line of code no one chose to regulate? Right now, a silent transformation is unfolding beneath the surface of global markets. Trillions of dollars of value are being reshaped, rerouted, and redefined by systems that promise freedom, speed, and decentralization. But behind the promise lies a question that will decide the future of finance itself. Who sets the rules when markets reinvent themselves? This isn't just a debate about technology. It's a high-stakes moment that will determine whether innovation strengthens trust or quietly dismantles it. Because when markets move faster than accountability, the cost is never theoretical. It's real, it's sudden, and it's paid by everyone. Stay with me, because what happens next will define how money, power, and trust collide in the years ahead. We are living in an era where financial innovation is moving faster than regulation, faster than public understanding, and in some cases, faster than common sense. That reality demands clarity, not confusion. When new systems emerge and begin performing the same economic functions as established markets, we cannot pretend they exist outside the rules that safeguard trust. Market integrity is not optional. It is the foundation upon which confidence is built, capital flows, and economies grow. Decentralized finance has introduced powerful new tools, but tools do not absolve responsibility. If a platform facilitates the matching of buyers and sellers, if it enables trading, price discovery, and settlement, then it is participating in core market activity. The mechanism may be coded, automated, or distributed, but the outcome is unmistakably financial. Ignoring that reality risks creating parallel markets that operate without the transparency, surveillance, and accountability that investors rely on. Regulatory clarity is not the enemy of innovation. In fact, history shows the opposite. The strongest, most resilient markets in the world did not grow in regulatory vacuums. They grew because participants understood the rules of engagement. Clear expectations encourage investment, attract institutional capital, and protect retail participants from abuse. Ambiguity, on the other hand, invites exploitation. It creates uneven playing fields where sophistication is rewarded not through insight or efficiency, but through regulatory arbitrage. Investor protection is not a bureaucratic slogan, it is a practical necessity. Without clear oversight, markets become vulnerable to manipulation, conflicts of interest, and systemic risk. Transparency in pricing, reliable disclosures, and enforceable standards are what allow participants to trust that prices reflect real supply and demand, not hidden incentives or undisclosed control. When those protections erode, confidence evaporates, and when confidence disappears, liquidity follows. There is also a broader consequence to consider. Fragmented markets weaken the entire financial ecosystem. When similar assets trade under different standards, price signals distort, risk becomes harder to measure, and stress in one corner of the market can spread rapidly to others. Uniform rules are not about suppressing innovation. They are about ensuring that innovation strengthens the system instead of destabilizing it. The objective should be simple: same activity, same risk, same rules. That principle has guided effective regulation for decades because it works. It respects innovation while refusing to compromise on core protections. It ensures that progress is sustainable rather than speculative, durable rather than fragile. The future of finance will undoubtedly look different from the past. Technology will continue to reshape how markets operate. But progress does not mean abandoning the principles that made markets trustworthy in the first place. Clarity, fairness, and integrity are not relics of an old system. They are prerequisites for any system that hopes to endure. If decentralized finance is to fulfill its promise, it must do so within a framework that protects investors, preserves confidence, and upholds the integrity of the markets we all depend on. Innovation does not earn immunity simply because it is new. History has taught us that progress in financial markets succeeds when it is guided by principles, not when it is shielded from them. Technology can change how markets operate, but it does not change what markets are. At their core, markets exist to allocate capital efficiently, to discover prices transparently, and to connect buyers and sellers under rules that ensure fairness. Those fundamentals do not disappear when transactions move onto a blockchain. There is a growing temptation to treat technology as a substitute for regulation, to assume that code alone can replace accountability. That is a dangerous assumption. Technology is a tool, not a referee. It executes instructions, but it does not judge intent, detect manipulation, or protect participants from abuse. When financial activity occurs, regardless of the infrastructure behind it, the risks to investors remain real. Volatility, conflicts of interest, information asymmetry, and market manipulation do not vanish simply because transactions are automated. A neutral regulatory approach is essential. The same activity should be governed by the same standards, whether it takes place through a traditional exchange or a decentralized protocol. If two platforms perform the same economic function but are subject to different rules, the result is not innovation, it is distortion. Capital flows toward the weakest oversight, not the strongest ideas. That undermines competition, disadvantages responsible actors, and ultimately harms investors. Allowing special treatment based on technology sets a precedent that markets cannot afford. It invites regulatory arbitrage, where success is determined not by efficiency or value creation, but by the ability to operate in the least regulated environment. That is not a path toward progress. It is a race to the bottom. Strong markets are built on consistency, where participants know that standards apply equally and predictably. There is also a matter of trust. Investors, particularly those without deep technical expertise, rely on the assumption that markets operate under a common framework of rules. When that framework fragments, confidence erodes. Trust is not built through complexity or novelty, it is built through reliability. Investors must believe that the system treats them fairly, that risks are disclosed, and that misconduct has consequences. Technology neutrality does not mean resisting change. It means embracing innovation while insisting on accountability. It means recognizing that new systems can coexist with established safeguards and that progress does not require exemption from responsibility. Some of the most successful financial innovations in history flourished precisely because they were integrated into existing regulatory structures, not isolated from them. The question before us is not whether innovation should continue. It will. The real question is whether it will evolve in a way that strengthens markets or weakens them. By applying consistent standards across all platforms, regardless of their technical design, we send a clear message. Innovation is welcome, but integrity is non-negotiable. That balance is what allows markets to grow, adapt, and endure over time. Financial markets are strongest when they are unified, transparent, and deeply liquid. They become fragile when they fracture. One of the greatest risks posed by poorly defined exemptions and inconsistent oversight is the creation of parallel systems that operate alongside established markets, but without the same standards. When similar assets trade in different venues under different rules, the result is not diversity. It is fragmentation, and fragmentation carries consequences that are often underestimated until it is too late. Markets depend on concentration of liquidity. Liquidity tightens spreads, improves price discovery, and allows participants to enter and exit positions with confidence. When trading activity is split across regulated and lightly regulated environments, liquidity thins. Prices become less reliable, volatility increases, and the very efficiency that markets are meant to deliver begins to erode. A system that rewards fragmentation ultimately weakens everyone who depends on it. The danger is not theoretical. History shows that shadow markets, those operating outside established frameworks, tend to grow quickly in favorable conditions and collapse rapidly under stress. Without consistent reporting, surveillance, and accountability, risk accumulates quietly. When market stress arrives, it does not respect boundaries between regulated and unregulated venues. Contagion spreads, confidence breaks, and the cost is borne not just by participants in those markets, but by the broader financial system. Fragmented markets also undermine fairness. Sophisticated actors adapt quickly, navigating between venues to exploit pricing gaps and regulatory differences. Less sophisticated investors cannot. They are left trading on distorted signals, often without full visibility into how prices are formed or risks are managed. That imbalance corrodes trust, and once trust is lost, it is extraordinarily difficult to restore. There is also a systemic implication that cannot be ignored. When large volumes of trading migrate to environments without robust oversight, regulators lose visibility into market dynamics. That loss of insight makes it harder to identify emerging risks, enforce rules against manipulation, and respond effectively in times of stress. Markets do not fail slowly, they fail suddenly. Effective oversight depends on having a comprehensive view of where and how risk is building. The idea that fragmentation promotes innovation is misguided. True innovation strengthens the system, it does not hollow it out. Innovation should improve efficiency, transparency, and access, not create pockets of opacity where risk can hide. A financial ecosystem that splinters into competing standards ultimately becomes less resilient, not more unified. Standards are not about protecting incumbents or resisting change. They are about protecting the integrity of price formation and the stability of the market as a whole. When all participants operate under comparable rules, competition is fair, confidence is higher, and innovation can scale responsibly. The future of finance will undoubtedly include new technologies and new market structures. But that future must be built on cohesion, not division. Markets thrive when liquid. It is deep, rules are consistent, and trust is earned through transparency and accountability. Allowing fragmentation to take hold may feel expedient in the short term, but over time it weakens the very foundation upon which sustainable growth depends. At the center of every functioning financial market is a simple promise. Participants can engage with confidence because the system is designed to protect them from hidden risks and unfair practices. That promise did not emerge by accident. It was built over decades through hard lessons, market failures, and the recognition that unchecked systems ultimately harm the very people they claim to empower. Investor protection is not a constraint on markets. It is what allows markets to exist at scale. When new financial models emerge, there is often pressure to move fast and break things. That mindset may work in consumer technology, but in finance, the cost of failure is measured in lost savings, broken trust, and systemic instability. Transparency, disclosure, and oversight are not relics of an outdated system. They are safeguards that ensure innovation serves participants rather than exploits them. Fair access is a cornerstone of market integrity. Markets must not be structured in ways that advantage a few insiders while leaving others exposed. When trading rules are opaque, when governance is unclear, or when conflicts of interest are embedded but undisclosed, the playing field tilts sharply. Sophisticated actors find ways to extract value, while everyday investors bear risks they do not fully understand. That outcome is neither efficient nor just. Transparency is equally essential. Investors need to know how prices are formed, how trades are executed, and how risk is managed. Without reliable reporting and surveillance, manipulation becomes easier and accountability weaker. Markets cannot function on trust alone. They require verification. The ability to detect misconduct, enforce standards, and impose consequences is what separates a credible market from a speculative experiment. Investor protection also plays a critical role in market stability. When participants believe the system is fair, they stay engaged even during periods of volatility. When they believe the system is rigged or unpredictable, they exit at the first sign of stress. Liquidity disappears, volatility spikes, and small shocks become major disruptions. Confidence is not just psychological, it is structural. There is a misconception that protecting investors slows innovation. In reality, it does the opposite. Strong protections attract long-term capital. They encourage responsible experimentation and discourage reckless behavior. They create an environment where innovation can be tested, refined, and scaled without undermining the broader system. The most successful financial markets in the world did not grow by avoiding oversight. They grew because oversight created credibility. The goal is not to shield investors from all risk. Risk is inherent to markets. The goal is to ensure that risk is visible, understood, and fairly distributed. When participants can make informed decisions, markets allocate capital more efficiently and resiliently. As finance continues to evolve, the principle must remain clear. Innovation earns its place not by bypassing protections, but by operating within them. Investor protection is not a barrier to progress. It is the bridge that allows progress to reach everyone sustainably and responsibly. Strong markets are not built on shortcuts. They are built through deliberate, transparent processes that balance innovation with responsibility. When rules are shaped hastily or through narrow exemptions, the result is uncertainty, and uncertainty is the enemy of confidence. If financial markets are to evolve responsibly, rulemaking must be rigorous, inclusive, and grounded in long-term stability rather than short-term convenience. A formal rulemaking process matters because it forces clarity. It requires ideas to be tested, assumptions to be challenged, and consequences to be considered before policies are implemented. Public notice and comment are not procedural obstacles. They are safeguards that ensure decisions are informed by a broad range of perspectives, from innovators and investors to regulators and risk managers. Markets are too complex and the stakes too high to rely on informal guidance or piecemeal exemptions. When regulation is developed behind closed doors or applied unevenly, it creates confusion. Participants are left guessing where boundaries lie, which rules apply, and how enforcement will be carried out. That ambiguity discourages responsible actors and rewards those willing to operate at the edge of compliance. Over time, this dynamic weakens trust and erodes the credibility of the entire system. Thoughtful rulemaking also creates durability. Financial innovation moves quickly, but regulation must endure. Rules built on clear definitions and consistent principles are far more adaptable than those designed to address a single technology or moment in time. A well-constructed framework can accommodate new models and platforms without requiring constant reinvention. That flexibility is essential in a market environment defined by rapid change. There is also an important signal sent by robust rulemaking that innovation is welcome, but accountability is expected. When innovators know the rules in advance, they can design systems that comply from the outset. That alignment reduces friction, lowers long-term costs, and accelerates adoption by institutions that demand regulatory certainty. Clear rules do not slow progress. They channel it productively. Inclusive rulemaking strengthens legitimacy. When stakeholders have the opportunity to contribute, challenge, and refine proposals, the resulting framework commands greater respect. Compliance improves not because it is forced, but because it is understood. Markets function best when participants believe the rules are fair, rational, and consistently enforced. The alternative is a fragmented approach where guidance shifts, exemptions multiply, and enforcement becomes reactive rather than principled. That environment breeds instability. It encourages speculation over investment and opportunism over discipline. In the long run, it undermines the very innovation it seeks to protect. The path forward should be clear. Build rules through transparent processes, apply them consistently, adapt them thoughtfully as markets evolve. Progress in finance is inevitable, but its quality is not. With disciplined rulemaking, innovation can scale responsibly, confidence can deepen, and markets can continue to serve their essential role in allocating capital and driving economic growth. So the question is no longer whether finance will change. It already has. The real question is who will shape that change. Will the future be built on clarity, trust, and accountability, or will it be left to drift in the shadows where speed replaces responsibility and innovation outruns integrity? Markets don't fail because they evolve. They fail when discipline disappears. And the decisions being made right now will determine whether this transformation becomes a foundation for lasting growth or a fault line waiting to break. This is the moment where rules meet reality, where innovation is tested by responsibility, and where the future of global markets is being written, not in theory, but in real time. Because in the end, progress without principles isn't progress at all. It's a gamble, and the stakes have never been higher.